Welcome to the Well-Off Podcast, where the goal is to motivate, inspire, and share success principles. I'm your host, George Masri. It's nice to have you back. I'm George Masri, the host, and today I interviewed Patrick Francey, who is the owner and CEO of the Real Estate Investment Network, or REIN, as some of you might know it, since 2012. He's a real estate investor, a business owner, an educator, and a coach since 1984. He's been an entrepreneur and the owner of multiple businesses. So him and his wife, Steffany, continue to expand their real estate portfolio while building and growing their businesses. And on this episode, we discussed the state of the economy. That's point number one. Point number two was opportunities for investors. And then number three are mistakes to avoid as an investor. I think there's a lot of good stuff in here. We did talk a bit in detail about what we think is going to happen with the economy, or what he thinks is going to happen, rather. So I think you guys are going to get a lot from this. And if you do, as always, I'll ask you to share this with a friend or family member. Let's get the word out there. And if you guys can give us a like and maybe subscribe on YouTube, it helps us with the algorithm, helps us grow, and leave us a review on the Apple Podcast platform, again, so that we can get the word out there. Thank you so much for all your support. It's truly appreciated. And I want to share that we have some multi-unit opportunities, triplexes, fourplexes, and larger in the Niagara region or in Hamilton. So if that's of any interest to you, make sure to reach out to us by going to welloff.ca and contacting us there, or on Instagram, welloffx. Enjoy the episode. All right, I'm here with Patrick Francey. Patrick, it's the second time that he's been on the show. The last time he was here, things were very different, but obviously things have changed in the last few months. And he's the CEO of REIN, so I'm sure he's got lots of insight as to what's happening. And I'm just curious to hear your take. So, Patrick, thank you for joining us once again.
You bet. Glad to be here, actually. It's good. It's nice to, I know a lot of people are taking the summer off, but it's still good to just stay a little engaged in what's happening in the world today, right? When it comes to real estate. Yeah. Yeah,
especially if you're an active investor. So I have three things that I'd like to cover with you. So the first one being the state of the economy. We'll go through a few points there. Number two would be opportunities for investors. And then number three would be mistakes to avoid as an investor over the next few months.
Right.
So let's dive right in. Just to start off, what do you think of the economy right now, just in general, and then we'll dive into some of these points that I have.
Well, something, when you look at an economic picture, you got to really look at a lot of different things today than you did, let's say, pre-pandemic, if you will. We've got a lot of global issues that are going on that are actually impacting us, in a bigger way. And not so much that they're impacting us today, but as investors, we're looking into the future. So we have to look 3, 5, 7, 10 years into the future generally, depending on what type of investing you're doing, and saying, okay, where do I think things are going economically, and what do I need to pay attention to? So certainly the global issues, whether it be Russia, Ukraine, or China, Taiwan, or what's happening in the UK, Eurozone, these are all things that actually don't seem to impact us directly, but have an impact on us because of supply chain. Of course, energy makes a big difference here. Economically, what's happening, as we're recording this today, we're looking at, employment starting to come up a little bit. GDP is going to be a little bit softer. And these are things that we want to keep a pretty close eye on. I mean, many are anticipating a recession. Some would argue that we're already in a recession. By the numbers, we're not. But if you're in the trenches like you are on a day-to-day basis, then you may see it differently. You probably do see it a little bit differently. So it's all to say that economically, things are quite fragile. Things remain uncertain. But as investors, we have to look into the future, not so much what's happening today.
Mm-hmm. Now, for those that are fearful of a serious market crash, kind of like what happened in the States in 07, 08, is that something you foresee happening? Or do you feel like where we're at today in terms of our economy, it's very different from where we were at about 15 years ago?
Well, I think it's quite different. It's a different set of circumstances, back again onto a global issue. We're looking at central banks doing things that they've never done before. we're looking at in terms of monetary policy, far different than it's ever been before. So it's hard to compare, and I know we want to historically compare. That's kind of where mentally we often go, and it's okay. It's okay to have a benchmark and then say, okay, well, where are we compared to that scenario? But it's just a different time. It's a different scenario. So it's hard to kind of extrapolate and say, okay, well, that happened then, so this will happen now. So I want to be cautious about that. Where the economy is going. Listen, it's my guess is, as good as anybody's. I may, have a thesis around what's happening economically and what's going to happen in the housing market. But to be honest with you, nobody knows. The Bank of Canada doesn't know. Economists don't know. Nobody really knows. There's a lot of, like I say, there's a lot of speculation, and there's various theses. All have, probably grounds. In my world, we have to consider this. This is how I look at it. We have to look at what's happening in the real estate world from a regional point of view, not a national point of view. Often we get caught in the headlines, which is always pointing at what's happening nationally. So when we look at what's happening in Toronto / the GTA, Hamilton, Peterborough, Barrie, for example, totally separate, different regional markets, and yes, some will have similarities in that area. But then you come over to, let's say, what's happening in Alberta, Saskatchewan, British Columbia, totally different world. So is there a bubble? Will real estate crash? I think if you compare what's happening today to what was February 2022, prices have pulled back. When you compare them to what's happening in 2018, 2019, not so bad right now. Now, having said that, is there room for more pullback? I think yes. I think in Ontario you'll see a little bit more, but I don't think it's going to be a devastating crash. Now, having said that, if you bought in 2022 a pre-built that's coming online and you've got to get financing on it, you're probably a little freaked out. That could be part of it. So it's there's lots of nuances, and is to say, there's lots of nuances. Everybody wants definitive answers, and there just is none.
Sure. Now, one thing you mentioned, just pre-construction, that seems to be very common now for developers to postpone their projects. They're postponing their sales and whatever else, which is actually impacting supply negatively because we already have a shortage of supply. How do you think that's going to play into this whole, I guess, the price of real estate and the supply in general?
Well, I think there's a couple of different components here. We're investors. So, if you're buying a pre-build with the intention of getting a lift on it and either assigning that deal before you have to close and or hanging on and reselling and selling for appreciation, that's a way different conversation than, let's say, an investor who's got a buy and hold strategy. There's a couple things that we understand. First and foremost is that in the rental market, because affordability really hasn't changed. At one point it was because the prices were too high. Now it's, your interest rates are higher, so your payments, virtually the same. What that's creating is an opportunity for investors to be that rental housing provider. And we know that, and we're seeing already, we've been talking about this for a year and a half within the Real Estate Investment Network, rents and the demand for rental units is going to continue to increase because behind all of that, we have to consider, of course, what's happening, which is the immigration and that's coming into the country that lands primarily first and foremost Toronto, Vancouver, Montreal, and those areas.
Got it. Okay. So different things here that are impacting the market. And like you said, there's a lot of uncertainty. No one really knows what's going to happen. Top economists can't really predict what's going to happen. Just in terms of interest rates a little. So we've seen a few hikes and the prime rate is sitting at somewhere, I think it's 4.5% roughly at this point. Do you see that continuing? And like, what sort of impact do you think that's having? Do you think they've overcorrected at this point, or do you feel like that was the right move just based on what you've seen so far?
Well, I think, we have to look at, do I think it's the right move? I don't personally. I know why they did it, and I see that it needed to be done. So I shouldn't say I don't think it's the right move. I think it was necessary to bring things up again. But when we look at inflation and the cause of inflation, we got the cause of inflation, from my perspective, my research was primarily driven by the breakdown of supply chain. And so when you can't get goods, of course, the pressure's on fewer goods. Having said that, to slow the housing market down. What we know about banks and central banks is they're slow to react. I think that there's a very good chance that they'll raise rates again, and in September, and I think they'll actually intentionally, this is just my view of it, I think they're intentionally going to drive a bit of a recession and slow things down.
Mm-hmm. Okay. All
but
right.
I want to go back. I want to go back to one fundamental thing is that one of the things that we teach investors is around the long-term real estate success formula. And so I want to just point this out to everybody. If they're keeping notes, GDP, you got to keep an eye on that number. You need productivity and you need production. So that's important. Then you get job growth. And of course, when you get job growth, then you get interprovincial migration, people coming into the jobs, which is increasing on rental demand and ultimately houses. So there is a method to the madness, but if somebody is an investor sitting here going, I wonder what's going to happen, watch your GDP numbers, watch your employment, watch your immigration. That will tell you a lot about where the market is going.
Absolutely. And we know that immigration, well, specifically in Ontario and in certain other provinces, that's been consistent throughout the last few years, and they're projecting bringing a lot more people in. So that's one thing. If you're in Ontario or in British Columbia or in certain other provinces, you're going to do pretty well on that end. So let's go to point number 2, which is opportunities for investors. Now, you mentioned rent a little bit. There's been a consistent increase in rent prices over the last few years, and we've definitely seen a bit of a spike since the interest rates have increased over the last few months. And I assume that you believe that this will continue and that rent will continue to be I guess, a strong point for investors to focus on.
We, as investors, we always, depending on your strategy, and I'm speaking primarily to buy and hold, which is probably the more common, although when you get into Ontario, Vancouver, you're getting investors buying for appreciation. That's a different game. And if you're going to play that game, then you're at the effect of what's your plan B, what's your plan C. Okay, so if that property doesn't appreciate, if you have to close on the deal, but let's just say for investors, I think the opportunity is in fact a buy and hold strategy. If you're buying for cash flow and over the next few years, you can pretty much count on over the next few years having rental increases. Now, having said that, we can also anticipate likely that we're going to have, governments come in and go, okay, we got to control this as governments do. So it's not going to be this straight line up. I think there's going to be some chaos as we're seeing it more in Ontario, BC, of course, Alberta, Saskatchewan, as an example, don't have those issues. And I don't think those will change because we know that rent controls don't work. So Alberta and Saskatchewan continue to be a competitive market in that regard. So that's all to say this: for strategies, look at what the demand is in the market that you're looking at. So, for example, I wouldn't buy a condo in Edmonton or Calgary as an investor. I just wouldn't. There's a glut in those areas. So you have to know those areas. Having said that, in Ontario, when you look at, for example, what's happening in Alberta, in Hamilton, I'll just use that as an example because it's fresh in my memory. There's a lot of upside going on in Hamilton right now, and some think it's run its course. But at the end of the day, if you look at the infrastructure they're building, the transportation changes they're making, the economic development that they're committed to, I see some really strong upside continuing in that market, which will draw, by the way, all of that will draw more immigration, if you will, or interprovincial migration to the jobs and to that lifestyle. And you'll see real estate prices go up as well as rents.
Absolutely. And we did mention rates a little bit in the past. For those that have a variable mortgage, investors, and maybe they purchased last year when rates were really low and the property cash flowed, but now as the rates have increased, they might be in a situation where the property is negatively cash flowing. Do you have any tips or any suggestions for people in that situation?
Well, there's, depending on when you bought, of course, that always comes up. I mean, we look at it and say, okay, can you sit down with the bank and re-amortize? Can you expand and bring those payments down a little bit? So you use those kind of the strategies to try and bring those payments down. I think the other part of it is that we have to look and say, well, how long do we think the rates? So first and foremost, that we cannot step over, and that is that interest rates are still at historical lows. What happened, of course, is central banks came out, Tiff Macklem, our Bank of Canada guy, drops rates and says they're going to stay low for a very long time, which they really didn't. He was talking 2023, yet, early 2022, we start to see rates go up. Having said that, there's still historical lows. And I think what's going to happen is that you're going to see rates ultimately pull back, but you're going to have to ride it until, probably mid to late 2023. That's just my own estimation of it. And I might be full of shit, but that's kind of how I'm looking at it.
Do you think it's sustainable for us to keep rates at around the 5% mark over a 5 or 10-year term?
I think it is, but it's going to take a lot of adjustment to get there. When I first started investing in real estate, I was paying 6.5%, and it was working. I was getting cash flow because everything kind of stays relative, but it's going through this kind of eye of the needle and this discourse and the adjustment period that has to happen. To your point around developers pulling back, for all the reasons they're pulling back, and there's many of them. Even they have to kind of adjust to this shift in costs, so these are all things that, yes, I think that's sustainable. It's probably even healthy, to be honest with you.
Mm-hmm. Yeah. And do you think that from a financing perspective, will it become more difficult for investors to get financing, in your opinion?
Oh, that's a good question, because there's a couple of different moves that the bank's probably going to make, not the least of which is, shifting stress test. I think the pressure is going to be on our federal government to provide, housing. And at the end of the day, investors do that. And as much as our federal government's supposed to be separate from our Bank of Canada, our central bank, they're pretty much joined at the hip. So as much as they're not supposed to be that, in the truth of the matter is they are. They're very connected at the hip. Mm-hmm. And so those adjustments are made. Those are political moves, and I think that, is there a risk of it? For sure. But I just see they need housing. They're, like I say, they've got immigration coming in, and they're going to be really thin on supply in different areas.
Right. Okay. So I guess we'll have to find out and see what happens with financing. But what about losing access to credit? I know in the past I've heard from others, because I haven't been investing as long as you have, but people have mentioned that in the past the banks have pulled back the credit that they provided through like a line of credit or something. They might say, hey, we're shutting this down. You can't use this anymore. Do you foresee anything like that happening, or what should investors do to protect themselves from that situation if they wanted to?
Well, I think first off, don't ignore it. Number one is that if you've got some financing from a monoline lender, I'm going to give you an example. Many years ago, I had a multifamily in Alberta, and I knew I had to renew in, I think it was about 18 months. That was right. Yeah, that was like in 2009, and I had to renew so I noticed that in 2008. And I had to renew in 2009. So I was just being proactive. So I had the mortgage with ING, and, I phoned them and I said, so, I'm just looking ahead, what am I going to have to supply you to qualify and to get this mortgage carried forward? And they sent me a note saying, we will not be refinancing that building. We're not refinancing anything in Alberta or in that region of Alberta. Mm-hmm. And it was only because I was fairly liquid that I pulled that off, but it was 18 months to get financing on that building through that downturn. And I had to write a check for $250,000 to get the financing. So they wouldn't finance it, even what it was. And it was a great building and it was cash flowing, but that's just how tight things were. Mm-hmm. And it was in Alberta, and the bank, and this is something that anybody listening to this, you have to look, the banks look regionally too. They look at postal codes, and although they don't talk about it in behind the scenes, if they're looking at a province or a city that they're thinking is a higher risk, they're going to make you jump through far more hoops.
Right. Absolutely. Yeah. So just staying aware, being proactive, like you said. If you feel like there's any chance that you might not get financing, if you have a renewal coming up, just call ahead and take action.
And it's something it's as simple as, and this goes back to what we always say: investor-focused mortgage broker, investor-focused realtor. Those are two people that you have to have on your team, but they've got to be investor-focused. Mm-hmm. Nothing wrong with home guys or home people, realtors, for example, or mortgage brokers. They just don't think the same. And so as an investor-focused broker or realtor, if you're having a conversation with that mortgage broker, in advance, you're looking at your portfolio and saying, okay, this is what I've got going on 6 months, a year and a half, whatever it might be. What do you think? What do you see in here? And you might get some insights. So the point is, don't leave it to the last minute.
Yeah.
Don't assume anything.
Right. For sure. So that's great. A couple tips there for the listeners. And then point number three, which is mistakes to avoid as an investor. I know we kind of touched on that a little bit just now, but can you think of anything else that investors should be looking out for over the next couple months? Maybe along the lines of over leverage, negative cash flow, something like that.
Yeah, there's a few things in this whole point. Let's go back to what's happened, right? Which is, people were doing a lot of emotional investing, which I call speculating. They were driven by, all these people seem to be getting rich in real estate. So they jump in, they really don't understand what they're doing. So step back and get out of the emotion of things. Now, what happened is that when markets are all rising, everybody's a real estate genius, right?
Yeah.
And what's happening right now. And then many are sitting on the sidelines during that period going, I'm waiting for the market to come down and pull back, and then I'm going to start investing. Well, then the market slows down and pulls back, and they're into the emotion of it. They're going, holy shit, the sky's falling. I'm out. This thing, the whole thing's going to crash, right? So it's an interesting mentality of what's happening. And so I guess my point in all of this is, number one, avoid the emotion of it. Look and have a plan, 5, 7, 10 years. If you're sitting down with your broker, your realtor, ask yourself, what is my plan A and what's my plan B? So for those who are, example, buying into a market where they're going, I'm buying for appreciation. My plan is to assign this deal, or my plan is to sell this deal before I have to get a mortgage. Whatever the story is around it, perfect. What if that doesn't happen? What if things change and you can't do that? So, there's a lot of planning that has to go in. So number one, have a plan. Number two, work with investor-focused mortgage broker and realtor. Number three, what is your plan B, plan C in these cases? And don't get caught up in the downside. In all of this, I will say this. REIN's been around 30 years. I've been part of this community for well over 20. And here's what I've learned through it all. There is no bad real estate markets. There's just bad strategies in that market. There's times where fix and flip works and buy and hold works, and there's times when it doesn't. There's times where an agreement for sale is great or a rent to own strategy works, and there's just times where it isn't. So adjust your strategy to fit what's happening economically, but understand this: there is a ton of opportunities that are going to show up, and are showing up. And if you're standing on the sidelines right now waiting for something else, like another shoe to drop, whatever it might be, you're going to miss some great opportunities.
Yeah. We mentioned just a little bit about being over leveraged. At this point, if you're an investor with a portfolio and you got a couple properties, where do you think you should be in terms of your portfolio's loan to value? What do you think would be a healthy number, or just in general?
Well, I think there's a that's a great question, because here's the thing around it is that whatever your thesis is. So for example, I think there's going to be a slowdown economically. Well, what does that mean? Well, financing could be tough. Means, we may see, I don't know, perhaps we start to see vacancy spike in the regions that I'm investing. So what am I going to do? Number one, I'm not going to over leverage. Number two, I'm going to make sure I have access to capital, liquidity somewhere, either in cash and or at least access to a line of credit. Now, if you're really liquid and let's say you've got 90% loan to value, if that was a thing for an investor, it's fine. As long as you've got cash to cover any shortfalls that show up, you're in good shape. You have to assess what your leverage levels are based on what you have access to from a liquidity / cash point of view. So, if you're planning for a recession, make sure your tenants are looked after. Make sure your properties are, up to speed. These are things that we have to look at from treating your real estate investing like a business. And that is, just, you don't have to freak out, but batten down the hatches. Look at where the potential energy leaks are. Look at where the gaps are and make sure those gaps are full.
Yeah, absolutely. So that's a good tip in terms of preparing for the recession, making sure you're not over leveraged. Do you feel like there's anything here that you'd like to add? Any important things that we didn't cover so far?
No, I think we've pretty much, for this particular conversation, I think we covered it all. Again, real estate's regional. Look very closely at whatever region you're investing in. And I have to say this, here I am in the Fraser Valley, you're in Ontario / Toronto or some region of that. Here we are having this conversation. I don't need, as an investor, to be focused on my backyard. It is just so easy. We got phones, we got, FaceTime, we can walk through buildings, we've got investor focused talent on, at the other end of that line. So my point is, if you're Ontario, you can invest anywhere in Canada. If you're in Alberta, and it goes wherever you are, look at the regions and look at what some of the strengths of these regions are as an investor. We're seeing a lot of capital, for example, flow into Saskatchewan right now, from Ontario, by the way. Mm-hmm. People pulling out of that Ontario market, pulling capital off the table and moving it over to Saskatchewan and Alberta, primarily because that's where we see the strength of the market.
Mm-hmm. There's an interesting thing that happened last year when I was talking to people, investors. A lot of them were starting to purchase in Nova Scotia. Mm-hmm. And from my understanding, Nova Scotia implemented rent control as well a couple months ago. So it was kind of like this speculative investment, mm-hmm. which ended up hurting them because a lot of them were investing because there was no rent control. Is that like, how do you protect yourself from something like that as an investor and make sure that you don't get caught in that?
Well, there's something, this goes back to East Coast. It doesn't matter where, okay? What's driving the economy? So rent controls aside, because there's always ways that look at rent controls in Ontario, yet their rents are at record highs, okay? Because there's always a churn and there's always the opportunities. But here's the thing about it. You have to look economically what's happening. And you have to look at employment. You have to look at industry. You have to look at where the jobs are and what's happening economically. I cannot stress that enough. Mm-hmm. I share often. I invested a lot in Grand Prairie, Alberta, through the boom times of oil and gas. And as much as Grand Prairie is well over 50,000 people, we really learned a hard lesson there, which is they were really a one-horse town. And yes, they got hospitals, and yes, they have other industry, but the main driver of all of their economy, the hub of all of that, was oil and gas. From that, everything went out. So when oil and gas collapsed, so did the rest of the economy, because everybody's depending on those jobs.
Yeah, absolutely. Yeah, I think it's kind of the same thing. There's some markets here, like in Northern Ontario, where it's either just a mining town or whatever, and that's the main thing. So I would definitely personally stay away from a market like that.
Well, that's a good point. But here it goes back just briefly, is that, sorry to interrupt on that, but you reminded me of another, just a clear point when we look at mistakes people make, is they buy for price. Mm-hmm. And prices, we're buying it cheap. Well, if you're buying in Timmins, Ontario, there's a reason it's cheap.
Yeah.
And so why are you buying it? What's the upside? What's rents? Where's your margin in terms of what you're going to earn in that property? So Don't buy it for price. Look at the economic fundamentals.
Yeah, absolutely. Okay. Well, do you have any upcoming events through REIN or anything that the listeners should know about if they're interested in finding out more?
Yeah, if you're interested, we've got what we're calling an economic summit coming up in September. I don't know the date off the top of my head. I want to say September 17th, but if you go to our website, REINCanada.com, all that is out there. Right now, really low price on tickets. They go up as we get closer to it. Mm-hmm. We're having some really cool economists and in the trenches speakers that'll be giving us an economic update of what's happening in Ontario, what's happening in Western Canada, but literally in the trenches. One of the things that we're really proud of is our relationship with people that are actually doing work. And I look at data the same as everybody else, but data is lagging. And when you can surround yourself with people who are literally in the trenches, who understand the market, then you get real live information. And that's what September is going to lead up to, is really having a great lineup of speakers. We're releasing our top towns reports, looking right across the country. I think we're releasing 52, 50, something like that, over 50 cities and towns that we're going to look at and say, where are they in the real estate cycle, with a kind of a paragraph on each one of those. So we're got the research team working hard in behind the scenes to look at that, and just to give investors lots of insights.
Mm-hmm. Awesome. Well, I'll be sure to include the website in the show notes so that anyone listening can check it out. Patrick, thank you very much. I appreciate your time today and all the knowledge you shared, and I look forward to speaking with you again soon.
It's awesome. I hope this is helpful.
Thanks for listening to this episode. Your support is truly appreciated. And if you can share this with a friend or family member that might benefit from the information, remember our goal is to motivate and inspire others to take action and to build wealth and to become well off. Enjoy the rest of your day.